Hi everyone, I'm Lynette Zhang, Chief Market Analyst here at ITM Trading since 2002. Since 1964, I've been a collector and a banker and a stockbroker, so it should be pretty easy to see that I have been groomed for this moment in time. And frankly, I am on a mission. My mission is to translate financial noise into understandable language. A little disclaimer before we begin. ITM recommends that 5 to 20% of your overall investment portfolio be placed in precious metals. However, the decision as to how much to allocate is strictly up to you and/or your financial advisor. You need to be aware that my opinions may or may not reflect the opinions of ITM Trading. So, without further ado, let's translate. And we're going to start. Let me get my little laser here, but we're going to start with perception management because we all know that in 1971, Nixon severed the relationship of gold to any currencies. In other words, closed the gold window. And so we shifted from a system, a monetary standard that was based on gold and dollars to one that was then based on debt, oil, and dollars. Now, I have a question for you. If you had known that that meant you would be trading your hard labor and efforts and your savings to an instrument that was specifically created to inflate your wealth and your efforts away, would you have agreed? Well, we can guess that the answer would be no, and the government also made that guess. So in 1974, the bankers created the first speculative derivative market, and they started with gold. Now, if any of you want to read this, again, let me know. I will send you the link. You can read this whole thing. But they specifically stated that they would be able to create enough derivative gold to create enough volatility in the markets to keep people away from buying gold once the initial surge had abated after the deregulation. So there you go on that perception management. And this is where we begin. Now, this is world income. This is world debt, all right? This is where we started, and this is GD stands for gold derivative. And right here with that little blue box is the tipping point, and this is what I mean. Now, when they make these transitions, and we saw the same thing in the transition from a gold standard to a gold dollar standard back in 1913, they want to lull you into a false sense of security. So can you see how this purple sort of dotted dashed line goes above the blue debt line? So you were feeling like you had more money than your debts, no problem, and we were lulled into a false sense of security. But after that, what happened? You had two derivative well, there are more things that happened in between, but two major derivative explosions, one in 99 with long-term capital management, and then, of course, the one that we remember the most, which is the crisis of 2008. And look at the answer to those crises. Bankers are about debt. And can you see these extreme levels? But that also means that on midnight, December 31st, 2016, power shifted from the U.S. with quote-unquote the world reserve currency to the IMF and the emerging markets. This is the BRICS nation right here. So that's Brazil, Russia, India, China, and South Africa. They now have enough voting power at the IMF to replace the dollar in global trade with SDRs. We're going to talk more about that, but hey, Happy New Year. And of course, how do you make that shift and that transition? You create distractions. So if you remember back in the early 70s, we had the Vietnam War, we had the oil embargo, women's lib, lots of protests, civil rights, lots of things were going on that distracted us from that shift. And as Rahm Emanuel said very, very clearly, you should never let a serious crisis go to waste. And what I mean by that is that it's an opportunity to do things you think you could not do before. And if you think about negative rates, that is a perfect example. Never before in history have we had negative rates, but we do now. So make no mistake about it, financial crisis 2 is coming, and most likely, in my opinion, very soon. And that's what we're going to talk about today. The crisis, the bail-in, and the SDR. And the first question that a lot of people ask me is, well, if this is happening, then how can they keep people inside of the system so that they can be robbed of their wealth? And we're going to look at that. In addition, we're going to talk specifically about how this next crisis is most likely to impact you personally. And then finally, what will it mean to us as Americans if the SDR replaces the dollar as the world reserve currency? So let's start with the first question, which is how do you get people to volunteer? And really what you do is you just create an environment where, like I showed you with the gold derivatives, that they're not really seeing the truth. And I want you to tune your ear to the term notional, because you'll hear it a lot. I know I talk about it a lot because I want you to understand. Or nominal. Whenever they talk about notional or nominal, what they're really telling you is that they are hiding the true value at risk. Okay, so let me show you how they did it real briefly as an overview. Because what they were looking to do after the system broke in 2008 was to buy time to get the next system in place. And they do that by growing a mountain of debt. Now, these 3 debt charts, I could have put a lot more on there, but I want you to look at this pattern because they grow a whole lot of debt, and then on top of that, they actually leverage that debt through derivatives. So they chop them up and they put them, they call it securitization. They convert them into a product that they can sell over and over and over and slice and dice them and over again. The other thing I want to point out in here is that this is a report from the Office of the Comptroller of the Currency, this particular chart, on the speculative derivatives in the FDIC insured banks. And I'm coming back to that in just a minute. So you see this pattern, right? See this pattern? Now look at this. This is called the reflation trade. By pushing all of that new money and debt and credit into the stock market, into the bond market, into the real estate market, they have reflated what was already seriously overvalued. And they have to do that. But I think you can see the correlation between those patterns. Now let me show you why they have to do that. We're going to look at this in just a little different way, because most wealth these days, we've been well trained, they're held in intangible financial products. You don't hold them, and actually you don't even really own them, which is why nobody went to jail for what happened in 2008. They're the ones that write the contracts and establish the parameters of those contracts, and frankly, nobody ever reads them. So this blue area here represents equity or stocks. This green area debt, and yes, they've certainly gone up, but take a look at this red area. That's the growth of derivatives. So can you see how important this growth has been to the financial markets. And remember, a derivative bet, its price movement is based upon the price movement of the underlying asset or instrument, but it really doesn't have any relationship to it other than that. So these are bets against this and this, plus more bets against this. If this were to drop, then you've got a problem with all of these, and clearly it's the lion's share of what's in the system. So the next question becomes, well, okay then, who's going to pay for the next financial crisis? And if you keep in mind that that's where most people hold wealth, particularly retirement wealth, and you have pension plans and insurance companies, as well as any of these other products that are based upon keeping this floating and keeping it invisible to you, I think you can see the problem. But the system is broken and it needed to shift. So one of the things that you have to do is create laws that legalize the risk transfer trade. Now, I'm going to read the title of this act, and then we're going to look a little bit at it. But this happened in 2005, and it is called the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. When I'm done with this slide, you can decide for yourself how accurate that title is. It certainly made it a lot more difficult for individuals to declare a bankruptcy. And again, here's the lovely FDIC, so they're the ones that are insuring any money that you hold in the banking system, their report on how they're going to deal with that. Financial market contracts are actually derivatives. And you can see here that they actually have immediate, I can't barely read that, but you could probably read that on your screen. Can you read that for me, Eric? Yeah, let's see. Ability to terminate financial contracts, determine the net amount due, and liquidate any collateral underneath it quickly. Now, typically, in a bankruptcy, if I'm a vendor for a corporation, and let's say they like me, and they know they're going to declare bankruptcy, so let's say they decide to pay me. Well, if they do that and then declare bankruptcy within 6 months, they claw back the money that they gave me because theoretically, everything's supposed to be divvied equally amongst all of the creditors. But not in the case of derivatives any longer. Derivative owners, which are not you and me, they are the financial institutions, now have super seniority in bankruptcy. And they don't even have to have a relationship with that corporation. They could have just bought a bet that that corporation was going to go bankrupt, or that their interest rates would change, or any other number of things. So if they benefit and they have the ability to push a corporation over, might they do that? Because what this law is actually giving them the right to do is to go in there and liquidate all of the assets and take all of the money that's generated from that liquidation, leaving legitimate vendors and debt holders and anybody else that might have a claim against the company, SOL. So going back to Bankruptcy Abuse Prevention and Consumer Protection Act of 2005. You always have to watch how they name something, because it probably represents the opposite and they don't want you to know it. So that's that. Then, in addition to that, they pass laws that nobody reads, and certainly they don't understand it. So when they brought the DoddFrank Act out in 2010, even at that point, it was over 2,300 pages long. Lawmakers, Senator, Congress, they admitted to not reading it, okay? But it wasn't really finished then. Because even though it was passed in 2010, they're still, guess what, writing it 6 years later. And as of 4/14/16, it's over 22,000 pages of regulation. Really? I mean, come on, think about this. Who is it protecting? I haven't read the 22,000 pages of regulation. Maybe we get a lot of protection in there. But now I want to just briefly go over how the market risk has been transferred from the few, from those guys at the top, down to the masses, to the public. And if you've been watching these webinars, you know a rising market when volume is declining is a clear indication of market manipulation. That's real simple, and you can see it. This I just pulled out of stock charts. Anybody can pull that up, not a big deal. But look at this, and I'm sorry, I went a little too fast for me. Let me just go back here. But look at what the insiders are doing. Now, the insiders are boards of directors, CEOs, CFOs, COOs, so the guys at the very, very top that actually really understand what's happening with the company. And of course, they get stock, many of them do, as compensation. So it would be logical that they would certainly sell a certain amount of stock. But if you have mutual funds or ETFs, you probably have Apple stock. And Apple made a new high today, at least it did this morning when I was listening to it. So Apple made a new high today. But look at the insiders selling. That little gray or the little green area is their buying. This big rusty colored area is their selling. Now, what does that tell you? In the meantime, with interest rates at near zero, they've grown a tremendous amount of debt. So if you own any of that stuff, you probably have some Apple in there, but I just really strongly believe that you should always do what the smartest guys in the room on any given topic are doing for themselves. And to peek beneath the skin of the market, we just go just a little bit below, and it's amazing what you can see.